What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. In this week's episode, we have a special guest joining us for an important discussion. As always, I'll be here with my partner, Stephen Gregory, who leads the quantitative research effort at Piper Sandler. We're thrilled to welcome Don Schneider, Deputy Head of U.S. Policy Research at Piper Sandler. Don brings a wealth of policy expertise to the conversation. He previously served as chief economist for the House Ways and Means Committee under Chairman Kevin Brady and Paul Ryan, playing a key role in shaping the 2017 Tax Cuts and Jobs Act. Before that, he was an economist and budget analyst for Chairman Ryan on the House Budget Committee. Let's get started. Good morning, Stephen and Don. Welcome back to What's Next for Markets podcast. I'm very excited to have you back here. I'm not surprised you're back because I feel like the never-ending string of political volatility has certainly kept everything you're saying really important to investors. So let's start off the conversation and narrow it down to what are clients currently asking most about? What's their concern? What are their hopes?
Away from trade. Of course, there's a lot of interest in the legal case and the kind of future of trade policy. It seems Trump was very committed to his trade agenda. So I think that's going to continue, that we're going to have high tariffs for a long time. But the real focus of investors is on this budget reconciliation bill and what this does to not only our fiscal outlook, but the growth trajectory in the near term. So when I normally meet with clients, it's what is the timeline for passage? What can change? Will it pass? And what does it mean? So on the timeline, the House has passed this budget reconciliation bill. It's sweeping. It has tax cuts, tax extensions, brand new tax cuts, big spending cuts, and spending increases on things like defense and border security, as well as an increase in the debt limit. That bill passed the House. It's now over in the Senate, where it's going to need to see meaningful changes in order to win their support. I'd say the timeline for this is, now that it's over in the Senate, they're starting to release some legislative text. They will release more. They hope to be done releasing the text next week. They hope to pass it out of the Senate in the end of June. And then the goal would be for the House to go and finalize this in around the 4th of July, more likely the middle of July. But it would be these next couple of weeks are so important because the changes the Senate make should be the final ones. The goal is for the House to accept the bill as the Senate writes it. So that's why people are so fixated on the details right now. So what the bill does under a current score, the official government forecast would say this will add $2.4 trillion to the deficit over the next decade. But it doesn't really give you a useful indication necessarily of what it means macroeconomically, not only in the short run, but in the long run. Of that $2.4 trillion in new deficits, $3.5 trillion of that is simply extending existing tax debt. So of course, if we just extend existing policy, there's no new money in anyone's pockets. It doesn't make the deficit worse than it already is. So in reality, this is relative to a current policy baseline, actually net deficit reduction over that 10-year period. As for what the bill contains, it depends on how you construct it, but something like $1.8 trillion in spending cuts, that is going to come from three major sources. Healthcare, so cutting Medicaid spending, so that's healthcare for low-income individuals. Reforming the student loan program, about a $350 billion there. The Medicaid cuts are on the range of $800 billion or so. And then cuts to food stamps or supplemental nutrition assistance. So again, the low-income consumer losing about $300 billion there. The bill then extends tax cuts and enacts a bunch of new ones, about split roughly 50-50 in the short run between corporate tax cuts and individual cuts. The individual cuts are made retroactive, stuff like no tax on overtime, no tax on tips, a deduction for senior citizens, the interest deductibility on your auto loans, expanded SALT cap, expanded tax brackets, and enhanced child credit. So roughly next year, when we get into 2026, there will be about $200 billion in tax cuts for individuals, mostly concentrated in the kind of middle income consumer. And up to $150 billion of that might be paid out when people file their taxes in February to April. And then on the corporate side, they're doing the most pro-growth things possible. Consider if you cut corporate taxes and you're a business your prior investments will yield profits this year and you get a windfall reduction on those profits, but also a reduced rate of tax on your new investments. But what they're doing here is full expensing for equipment, R&D, and manufacturing structures. So you only get this deduction if you're doing new investment, and you would take what, like in the case of structures, for example, a 39-year property in which you would depreciate over 39 years, expense it immediately. So they're doing the most pro-growth things possible on the investment side. So I'd say overall, this bill, it should be expansionary in the short run, about 20 basis points as a share of GDP in 2025, 60 basis points in 2026. That's because the tax cuts are larger than the spending cuts in the short run. So that does mean it's going to push deficits higher, increase treasury issuance. The deficit could go from, say, 2 trillion now to 2.2 trillion next year. So that means higher treasury issuance and expansionary policy. But what the most important kind of then segue with clients and what we're trying to figure out is, okay, this is that Congress is now baking in a fiscal trajectory that is set, and it is going to be really hard to change because they're not going to legislate much more after this. So the next step is, what do tariffs do to this fiscal picture? And if Trump's tariff policies are unchanged, they're going to raise about $250 billion in revenue annually. And that will basically entirely offset the fiscal expansion of this tax package. So you're left with a budget deficit that's hovering around 2 trillion. So now we're more so arguing about the composition of growth. Is $1 of tariffs more harmful for growth than $1 of tax cuts is good for businesses or the consumer? And what is the sequencing? Like, when is peak economic drag from tariffs? When is peak kind of fiscal impulse from tax cuts? So I think clients are looking at that and saying, how does this distribution of growth feel? It feels growth negative to them and rates positive? It's kind of the net takeaway of where people are. And of course, there's all kinds of interesting things to digest in this bill, like the Section 899 tax increase on foreign multinationals and full expensing for structures, but that's the general conversation.
So there's obviously a lot of assumptions, a lot of forecasts, and a lot of uncertainty where things move in the next 10 years. How do you see that question about the relative timing of the fiscal impulse, whether it's positive or negative, and how the shape of that changes at the start of this bill through the 10-year period, and the impact on tariffs? Now, obviously, the incremental impact on tariffs is more or less immediate, so that'll be arguably a drag. Is there enough of a positive fiscal impulse in this bill, which seems to be front-loaded, to offset that? So I'm curious what you think about that.
Yeah. So, I mean, tariffs, the net expansion for the tax bill is effectively equally sized in just revenue or dollar terms to tariffs. So treasury issuance should be roughly neutral. But of course, that doesn't tell you whether growth is ultimately neutral. Tariffs are a broad-based consumption tax. Effectively, they're distortive. And the economic costs of tariffs should be larger than the amount of revenue we collect. You know, basic economics, you have revenue square, and then you have the dead weight loss triangle. So the growth damaging effects of tariffs are larger than the amount of revenue that we collect from them. And this whole period has raised business uncertainty, and that uncertainty is a big factor. But you're going to decide to onshore into the U.S., which would be the major incentive of some of these business deductions. Are you going to do so in a really uncertain environment? So my sense is that if these are dollar for dollar the same, and even when you think of the individual stuff, retroactive tax cuts do not change individual behavior. You cut someone's taxes because you want them to work more or invest more. But if they're retroactive, it definitionally doesn't change your activity. Of course, you have more money to spend. That money can have a positive but fleeting effect on growth. So I would say on net in the short run, and I think this part of the tricky part gets into like Nancy and Jake's world or your world, when after this inventory buildup and everything, when do we actually see the hard data turn from trade, and how negative is that? But yeah, my sense is this is like a net, a marginally negative policy for growth when you combine tariffs with this reconciliation bill. And I think some of the challenge too, like from an investor perspective, you look at this and you say, okay, the trade war has not necessarily been enticing for owning U.S. assets. And okay, maybe we won't increase deficits because tariffs will offset some of that expansionary nature of the bill. But this doesn't feel like a good policy mix in the sense that we're front loading a lot of tax cuts that will then expire. There will be an impetus to extend them later on, and kind of backloading the spending cuts. I think ultimately some of these tax cuts will get extended. And I think most of these spending cuts will survive. But again, just that overall policy mix, I think, doesn't give people a lot of confidence.
You mentioned the Senate and the potential changes. Where do you see potential changes, and are they material?
Yeah, so they cut in both directions. I would say for the next 2 years, our fiscal trajectory is effectively big. Like, this bill is expansionary because you have big business tax cuts, which are not changing, and you have retroactive individual tax cuts, which you're probably not going to change either, because if you don't do it, people won't feel them before the midterms. So the things that they're going to do really matter for, say, 2027 and beyond. They're going to do a bunch of things to make the bill, say, more extensive. So the top priority in the Senate is making full expensing for equipment and R&D permanent. That'll add another $500 billion to deficits over the next decade, but it won't change the impulse of policy over the next few years. They're just extending a provision that would otherwise have been temporary. They're looking at trimming the SALT cap. I don't think they can do very much there, given how important it is to the House. I'd say from a market perspective, some of the things that people are most focused on, these changes to the IRA. The Senate is going to change the phase-out dates of some of these renewable subsidies, so that will be beneficial for particularly solar companies. Then there's this big debate in the Senate about, can we find more in spending cuts? Because on the one hand, you have members, both moderate and conservative, or maybe populist, but who don't want to cut Medicaid spending. We're putting strictures around how you do it. So there's this provision in there that's going to hurt the hospitals, especially rural hospitals. And so that provision, what's known as provider tax, is probably going to come out. And there are a few conservative senators who are saying we need to not only backfill that loss of spending cuts, we need to do even more. And I think it's going to be really challenging to find more. So the net effect of everything is you'll have provisions cutting both directions. It might marginally worsen the fiscal outlook in the long run, but this bill is 85% of the way baked. So we know the most important contours of it now, and that won't change very much.
What is the risk that the bill doesn't pass?
Well, this kind of segues into the whole Musk and Trump feud and other things. This bill is do or die for Republicans. If you fail here, this is what happens next. You have to raise the debt limit before August. If you can't do it in this bill, now you've got to, hand in hand, ask Democrats for help to raise the debt limit. They're going to have demands. That becomes messy. You go home to your constituents over August recess with nothing to show for it, but in their view, funding the government at Biden levels and cutting potentially a crummy debt limit deal with Democrats. You come back in the fall, you have one more month until your reconciliation vehicle expires to try and get this right. But if you can't resolve the key issues now, which is the balance between tax cuts and spending cuts, it's probably going to be pretty difficult to do then. So then you're looking at maybe some kind of deal in the fall to just punt the tax code. And you end up not really have anything to show for your first year. And when you get into, say, next year, midterms are coming up and the window to legislate really narrows. So they really can't afford to not succeed here. It would result in a massive tax increase, and they would then fail to get their defense spending increases, border security. It's really critical. So I think that they will get there. I'm pretty confident that they will. Right now, you see the Senate conservatives pushing for as much new spending cuts as they can get. I'd say the Trump-Musk feud is really unhelpful in this, because Musk has been basically looking at this bill and says it adds $2.5 trillion to the deficit. There's all this pork in this bill. He called it a spending bill and said, kill the bill. And I think Musk may be unaware of what's actually in the bill, the fact that it depends on how you construe it, somewhere around almost $2 trillion in spending cuts, and then just even more tax cuts than that. And that's why it adds to the deficit. Is Musk effectively arguing that we should raise taxes on people? That's what he's saying. That's implied by what he's saying. I don't think he means it. But Musk has a lot of credibility on fiscal issues, and Republicans have deliberately elevated him through Doge and otherwise. So they've given him that credibility. And now for him to come out and say this bill is fiscally irresponsible gives more leverage, or puts members who are otherwise on the fence about voting for this some cover. And that's really unhelpful for Republicans at this moment. Ultimately, I think Musk is going to be ignored here. You're seeing Speaker Johnson, Majority Leader Soon, others basically saying, I think he's just wrong about this. And so I think it's unhelpful, but I think Republicans will ultimately prevail, band together, and agree and pass this bill in the middle of July.
Is there anything coming up in like the next week or so that you're going to be really focused on?
Yeah, I'd say the most important thing that will come out in the next week as it relates to reconciliation is the release of what's called Senate Finance Committee's legislative text. So unlike in the House, you have the Ways and Means Committee that controls tax policy, and that also controls the IRA. But the biggest and most controversial spending cuts in this bill are Medicaid. And that's a different committee in the House called Energy and Commerce. Well, now in the Senate Finance controls all of that: Medicaid, tax cuts, IRA, et cetera. So that's the most critical text. So, how I noted that once the Senate makes changes, there probably won't be any more in the House. So I think that's the key thing to focus on. Do they get this text out at the end of the week? What changes are they making on tax policy? Do they find some meaningful spending cuts that's going to increase the probability of passage? Or what else do they ultimately do? There will be a lot of kind of investor conclusions or policy changes that matter to investors, as well as in shaping the fiscal trajectory. So Senate Finance text at the end of the week is what I'm looking for.
Awesome. We will keep our ears and eyes open to see your reaction to that. One last question. We've had a lot of focus on tariffs. Now the focus is on the bill. Let's assume that this does get passed in July, as you expect. What is the next major policy focus of investors following that?
Yeah, split it into the administration and Congress. There will be legislative exhaustion. There is just not much left to do, but there will be a big push to keep cutting government spending. Whatever they can't get into the bill, there's just going to be this drive to do more, to legislate the DOGE cuts. We, of course, have to fund the government by September 30th. I'd say the odds of a shutdown are quite high, given that you have the Trump administration and fiscal conservatives saying, we're done funding this government at Biden-era levels. We need dramatic cuts to non-defense spending. And unlike what happened before, where fiscal conservatives finally agreed, they normally never vote to fund the government. They said, okay, we'll keep spending flat. And when that bill made it through the House, much to everyone's surprise, and it came over to the Senate, Senator Schumer had a choice: shut down the government over DOGE or just eat the House bill, which keeps government open at flat levels. He was forced to eat the bill. Now that everyone, including the White House, is pushing to cut spending pretty dramatically, the Democrats have a much stronger hand to play here and say, no, I'm not going to agree to do that with you. And it just increases the probability of a shutdown. And of course, what are called rescission packages, where the White House will say, we don't want to spend this money, mainly cuts identified by DOGE, and say, Congress, please legislate this solution. And Republicans can do that without Democratic votes through a unique process. So I think within Congress, the focus is just going to turn to routine funding of the government and how difficult that's going to be, like signing into law the DOGE cuts. But that's only a little bit of stuff. They're not going to do much more legislating than that. All the rest of the action is just going to be the fallout from Trump's court cases on tariffs, how he wants to pursue the rest of the trade agenda, whether there will be deals. And I think you're just going to see continued trade action through the rest of the year.
If I can ask a bonus question.
George?
What is this Section 899 that I keep hearing about?
Yes, this is one of the more consequential and controversial portions of the reconciliation bill. It requires a bit of history to understand what it does. But what it is, it's a retaliatory tax on foreign multinationals and individuals. Over the years, basically going back to the Obama era, countries have been imposing discriminatory taxes on U.S. companies, known as digital service taxes or diverted profits taxes, where basically our companies are profitable. We live in an increasingly digital world in which capital is mobile. They want to claim some of those profits, and they discriminate against U.S. firms by charging us. There's been really no success in stemming the tide of these discriminatory taxes. And basically, Secretary Yellen under the Biden administration opened Pandora's box when she negotiated what was called Pillar 1 and Pillar 2. Pillar 1 was a deal to carve up basically tech profits in a way that was unfavorable to the U.S. And the goal was, if we do this, we concede our profits, then please get rid of your digital service tax. That never happened. But that was the appetizer for the entree, which was Pillar 2, a global minimum tax. And the goal of that is basically, if every country in the world agrees to impose a 15% minimum tax then there's nowhere for capital to go. Like right now, you have tax havens in Ireland and the Cayman Islands and everything. But if everyone agrees to tax it at 15%, capital is effectively immobile. It's going to stay where it is. And politicians want to tax corporations more than they want to tax people. And so that they get, if capital is no longer mobile, then capital bears the burden of taxation. So that was the goal. But the only way to enforce that is through this thing called UTPR, the undertaxed profits rule. So if in theory, every country imposes their 15% taxes, both domestically and on a foreign basis, then everyone should pay 15%. But what if you don't? What if you decide to cheat and you don't do it? You need an enforcement mechanism. And all the dozens of countries are now imposing this tax, UTPR, which allows them, if you say, let's say Apple, you're supposed to be paying 15%, but you don't, you're paying 10%. All right, well, you're cheating. And then France would have the ability to say, well, Apple, you're doing business in our country. This formula prescribes that I can take a portion of that 5 percentage point gap. And so now they get effectively, we've ceded taxing rights to a foreign jurisdiction. This is extraterritorial tax. They get to reach into our tax base and tax our companies based on a deal that Congress never ratified and Republicans certainly never agreed to it. So that's where 899 comes in, which is how do you put this genie back in the bottle where we have discriminatory taxes and extraterritorial taxes. The way they're going about it is saying, fine, if you want to discriminate against us abroad, we're going to do it to your companies here. We're going to charge you a 5% escalating tax every year that goes up to 20% on various streams of income. So it's very complicated how it works. But I think the takeaway is mainly for foreign individuals, it would be the kind of the return on your assets really only through dividends. Portfolio interest is exempt, so there's no tax on treasuries and interest. Capital gains, there's no change in taxation there. You basically tax on a residence-based system. But if you're receiving dividends from U.S. equities, you'll face a 5% escalating tax, up to 20% if your country does not remove those discriminatory taxes. And then on the corporate side, businesses pay a 21% rate in the U.S. It depends on how they're structured, whether they're what's considered a branch or a CFC, a controlled foreign corporation. They would face higher rates of tax, and it would depend. Like, for example, if you thought of Toyota USA, they're a U.S. incorporated company, even though they're controlled by the Japanese. They wouldn't face an increase in their corporate rate from 21 to 41%, but they would be thrown into this really onerous new minimum tax. And any dividends paid from Toyota back to the Japanese parent would face this escalating 20% tax. So it is a really big deal. The bottom line is the goal is to fight back against discriminatory taxes. And if it's unsuccessful, it will raise taxes on the countries that comprise 80% of the total stock of FDI in the US. So it could be completely counterproductive to Trump's goals of onshoring if now we're taxing the returns on that investment in the US. Or the flip side is it works. Countries say, all right, we don't need this revenue from our digital taxes and these discriminatory taxes, we'll abandon it. And then US companies get more competitive.
Wow. Incredibly interesting. There's so much going on in DC right now.
Thanks, Don, so much for joining us. That was a tremendous amount of value-added insights on a very complicated and fast-moving subject. This year, I can't think of a year that's had more wild cards on the bingo card than 2025. Who would have thought we'd have the highest tax increase in the form of tariffs in the market middle of the year, pretty much back to their all-time highs, in the same week that President Trump is tweeting about Elizabeth Warren in a positive light and going after Elon Musk in a negative one. So we'll continue to expect the unexpected and look for you to help us navigate along the way.
Happy to. Thanks again.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.